If you want to understand Apple stock right now, you have to understand that there are two completely different stories the market is telling about its future. On one side, you've got the bulls who see this impenetrable fortress. And on the other, you've got the bears who see a giant facing some really serious headwinds. So let's break down both sides of the argument for one of the most important companies on the planet.
For any investor, really, it all boils down to this one question. What are you actually buying here? Are you buying a company that sells physical things like iPhones and MacBooks? Are you buying a high-tech software powerhouse that runs on subscriptions and recurring fees?
Well, the answer is, it's both. Of course it is. And this dual identity, this kind of split personality, is where all the tension and all the opportunity lies for an investor. It's like a tale of two very, very different companies living under the same roof. Okay, let's really break this down. You've got the hardware business, iPhones, Macs, you name it. It's massive, but it's a mature market, and sales go up and down. Then you have the services business, the App Store, iCloud, Apple Music. That's growing steadily. But here's the kicker. Look at those gross margins. About 35% for hardware versus almost 76% for services. That difference is everything. Every single dollar from services is more than twice as profitable as a dollar from selling an iPhone.
All right, so let's start with the bull case. The whole argument is built on the foundation of Apple's incredible ecosystem. This is what the bulls believe makes the company an absolute, impenetrable fortress.
So the power of that fortress comes from a concept that investors call switching costs. This is Apple's biggest competitive advantage, its economic moat. It's basically all the pain, and I mean financial, procedural, and even psychological pain, you'd have to go through to pack up and leave the Apple world.
I mean, just think about it in your own life. Your iMessages, your FaceTime calls, the way your watch and your phone just work together. Now imagine the hassle of moving all your photos, and even worse, having to rebuy all your apps and movies on Android. All of this creates this incredibly powerful lock-in effect. And the result? A customer retention rate that's somewhere between 89 and 92%. It's just wild. People simply don't leave.
And you can see this shift happening right in their earnings reports. Apple's gigantic user base is now feeding its new growth engine. Look at this. iPhone revenue, basically flat. Other hardware is actually shrinking. But then, boom, look at services, soaring with nearly 13% growth. This is that structural change happening in real time. 75.6%. This single number is why that services growth is so unbelievably important. That's the gross margin. It means this isn't just any growth, it's incredibly profitable growth. As services become a bigger and bigger piece of the pie, the profitability of the entire company just gets this massive, compounding boost.
And finally, the last piece of the bull case isn't even about selling more stuff. It's about what Apple does with its mountains of cash. It takes tens of billions of dollars and just buys back its own stock. A record-breaking $110 billion was just authorized. This reduces the number of shares out there, which automatically juices the earnings per share. It's a powerful tailwind for the stock that has nothing to do with day-to-day operations.
Okay, but it's not all sunshine and rainbows. Let's flip the coin and look at what's keeping the bears up at night. Because while that fortress is strong, it's also under attack from a bunch of different directions, and we'll start with the biggest threat of all, regulation.
And this isn't just one isolated lawsuit here and there. Bears see this as a coordinated global assault. You've got the Epic Games ruling, you've got the EU's Digital Markets Act forcing Apple to open up its App Store, and now you have a massive U.S. Department of Justice lawsuit that targets the very thing that makes the ecosystem so sticky. Each one of these is like a chisel, just chipping away at that walled garden.
Then you've got China. It's Apple's third largest market, which is huge, but look, revenue there dropped almost 8% year over year. This really points to a double whammy of risk. You've got fierce competition from local champions like Huawei, and then there's the constant geopolitical tension between the US and China. That's a threat to both sales and their supply chain. And here's the thing. Even if you ignore all those external pressures, the core hardware business is slowing down all by itself. I mean, our phones are just better and more durable now, and the yearly upgrades, they're not as compelling. It means we're all holding on to our iPhones for longer, on average over 3 years now. That puts a natural ceiling on growth for Apple's biggest moneymaker. So all of this brings us to the central dilemma for any investor. You have this high-growth, super profitable services business that's strapped to a slow-growth, less profitable hardware business. So what's a fair price to pay for a company with such a split personality?
Well, right now, the market is giving Apple a pretty hefty premium price tag.
Its price-to-earnings ratio, which is just a common way to measure value, is sitting close to 34. That's way higher than its big tech peers like Microsoft and Alphabet. That premium tells you that the market really, really believes in that high-growth services story. But it also means expectations are through the roof.
You know, a smart way for an investor to think about this is with a sum-of-the-parts framework. Basically, you pretend they're two different companies. The hardware business probably deserves a lower, more traditional valuation. But that services business, with its incredible margins and growth, that deserves a much higher software-like valuation. The current stock price is just the weighted average of those two, and the huge debate is whether that average price is justified. So if you're an investor, how do you keep score? How do you track which of these competing stories is actually playing out? Well, there are a few key metrics that are going to tell you whether the bulls or the bears are winning the argument.
Here's your dashboard. First, you've got to watch that services growth rate like a hawk. Is it staying strong in the double digits? Second, are those all-important gross margins still getting better as services become a bigger piece of the company? Third, is the total number of Apple devices in the wild still growing? And finally, you have to keep an eye on China. Can they turn things around in that key market? These are the numbers that will tell you the real story, quarter after quarter.
And that brings us to the one final question that really sums this whole thing up. The entire bull versus bear debate comes down to this. Can the incredible growth and profitability of Apple's services business defy the laws of gravity from its massive maturing hardware business, all while those regulatory walls are closing in? The answer to that question is what will determine the future of Apple stock.